So our guest today is named Mr. Chris Warren. He is from West Palm Beach, Florida, and he is got a great story. He is definitely a veteran real estate investor, and really represents what I call a ninja in the market, guys that did a lot of these transactions. And we're just going to bring him on and sort of talk about kind of the flow of events that kind of happened in his life and relevant to some decisions he's made in the last year to reposition his business. So without further ado, welcome, Chris.
Thank you.
How are you?
I'm doing great. How are you, Eddie?
Everything good in Florida today?
It's a beautiful day.
Well, glad to hear that. Spent a lot of time down there in that neck of the woods myself, and I know how beautiful it is. Pretty cool place to live. So a couple of things, like just give us a little bit of a background, if you can, Chris, of like what your real estate and how your real estate business started. And I think it'll make sense as we progress as to kind of where you've now ended up.
Okay. So I bought my first house in 2000, a nice house I plan to stay in for the rest of my life, not far from the beach. A couple of years later, I converted into a duplex and moved out and caught the bug then that I was going to start house hacking. So we were in a screaming market back then, 03, 04, 05. In Florida, the bubble burst in 05 when Hurricane Wilma came through. It was a little earlier than the rest of the country. But at that point, I had a handful of rentals that had more or less tripled in 3 years. The house I bought in 2000 was for $200. It appraised for $790 in 2005. I sold it in 2009 for $420 on the way down where it went below that. So I kind of got whipsawed in that market here and took a little bit of a breather for 10 years. Then when I decided to start investing again, I did it with an IRA. I bought a few small condominiums. I learned that there are some disadvantages to owning real estate in an IRA, some advantages, but more or less it doesn't make a ton of sense to use a tax efficient investment strategy in an already tax efficient vehicle. So I liquidated those and then started buying turnkey properties out of state. This was in 2017. My wife and I were both, working a lot of hours. I would say we had more money than time. And we studied the turnkey market and looked at all of I guess I'd say that was when I really began studying real estate and studying owning rentals a lot deeper. I poured a lot of time into it. I had an hour commute each way to work, and that was my university, all the books and podcasts. And I began moving my equity from Florida to Alabama because I could get a better return on investment, a higher rent to value ratio. I got out of hurricane insurance, which was definitely a big bite. In Florida, we don't pay income tax, so we pay extra property tax. In Alabama, it's the opposite. So if you live in a state where you have no income tax and invest in a state where you have low property tax, you get the best of both worlds. So I started building a turnkey portfolio by buying from other resellers. It aided me a bit because I was paying full price. Turnkey resellers get top dollar. Sometimes they're very much at the top of the market and there's not a lot of value add to put in there. Even still, that's the right investment for some people. Compare that to your 401k, I think it's still a good investment. But I decided to leave my job in 2018 and to go into real estate full time because I wasn't able to save up enough money to buy more than 1 or 2 houses a year. And I was running out of my 10 golden ticket loans, the 10 Fannie Mae loans that everybody can get. So I started a company in Birmingham while staying here in Florida. And I decided I'm going to create these turnkeys. I'm going to market directly to distressed sellers. I'm going to buy from wholesalers. I built a relationship with a general contractor who had rehabbed hundreds and hundreds of turnkeys for another provider. And in 2019, our first full year, we did a total of 20 properties. If you had met me in 2019, I would have said, I rehab turnkeys and I hold as many as I can and I sell as few as I have to fund the operation. The whole purpose was to get retired or to get financially independent through rental properties that I had rehabbed. So I had all of my value add. I had some forced equity. I had good properties, good property managers. I built that network, and I was somewhat happy with 2019, but I wasn't making a lot of cash flow. The rehab business is also very hard to manage. There's a lot of moving pieces with contractors and work and finding good deals. However, probably the biggest challenge is cash flow management. When you are timing the draws from the bank and you're timing the sales to the buyers, and there's a lot of those moving pieces, and then you're managing it from 800 miles away. And I love Alabama, but I don't really blend in there. I don't have the right accent. And I love the people there too, but I'm a Yankee when I go there, even though I live further south. But the bottom line is rehabbing is a very tricky business. And when I was trying to keep everything I could, the company was always running on fumes because every house I could, I'd hang on to. So in late 2020, I decided I'm going to stop rehabbing and start wholesaling instead. I met Ken Clothier, I joined Boardroom, I met a lot of fantastic wholesalers, and I learned quickly that that is a much faster, easier way to make a lot of cash and to control your supply line. So in 2020, I started building a team, and by the end of the year, I had 6 employees, and we did a total of 68 transactions. During 2020, we know what happened in March. And in June, I decided to stop accumulating rentals. At that point, I started meeting you in the summer of last year through several different podcasts and mentors. And I finally gave into the concept in October when I joined NoteSchool that I haven't changed paths, I haven't changed destinations, but the rental properties were not performing the way I wanted them to. And it looked to me like all of the people that I had a ton of respect for were starting to convert their rentals into notes. And because I had this wholesale business up and running, I had a great way to originate notes where I'm buying with seller financing. We talk to distressed sellers all day long. So my shift came in October where I decided, okay, I'm going to continue to stabilize the wholesale business and take about 6 months to stick my toe into NoteSchool, which to me was 5 or 10 hours a week of learning. And then in the spring, I would go all in. So I now split my time 50-50 between building note portfolio and running the wholesale business. So that's where we are today.
Great. That's quite a journey. So to clarify a couple of things, a turnkey house, for those of you that don't know what that is generally where a real estate, and I would call them a promoter, they have bought a house, fixed it up, loaded it with a tenant, and management is in place. And so turnkeys became very, very, very effective after the 2008 crisis. In fact, Chris, you got to know some of the very operators that I know really, really well, right? And they really grew their business exponentially. The reason is because houses would cash flow so well. In other words, the price that you paid for a house left, compared to its rentable value, it was, call it, too cheap, right? And so the turnkey model, and there were millions, like seriously millions of houses that went into that category. And that really had never happened. It certainly had never happened prior to 2008 to any measurable degree. But what's happened now is that real estate values have gone up, 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 and rents haven't matched that. And so now all of a sudden we start seeing rentals that the math doesn't work. Well, there's a reason why, right? The price of the house has gone up. The rental hasn't gone up and matched that percentage. And so once again, we find ourselves in, Chris, what I call now more of a note cycle than we are a rental cycle. Is that what you experienced?
Exactly. I can tell you that 5 years ago, I could buy a house, pay full retail because I'm too busy to find it myself, pay $80,000 and rent it for $900. And that'll cash flow. Now that same house will rent for $950, but it'll cost $110. Eddie, I actually showed you one of my rentals that I owned a couple of weeks ago.
Yep.
I had bought it for 43, put 15 in, and I wanted to owner finance it. And I mentioned to you, I have a buyer who pay 80. And you said, what? That's crazy. Grab that. And I did.
Yeah.
It just resold for 115. And it still rents for $800 a month. So it's like you always say, you say the fools are out. 4 years ago, it wasn't foolish. If you're a doctor or a lawyer, you're working 80 hours a week and you're looking at the stock market saying, hey, it's gone up a long time, let's diversify. As long as the math works, it's fine. But what I've learned is the danger is when you get that pro forma, that 1 year snapshot projection of the first year of ownership. I stopped using those even when I would sell those houses, because they may work the first year, but I try to go out and model 20 or 30 years. I actually built a table because if you've got a 4-year-old air conditioner, you better plan on replacing it in 10 or 11 years. And if you have, your tenants are in there, everybody says, oh, put 5% aside for vacancy. No, plan on a vacancy every 2 or 3 years and a $4,000 turnover and a new listing fee to your property manager, and then a brand new tenant you don't know and you're praying pays. And when you keep modeling out each successive year and you build in the major expenses and the major repairs, if you're investing for cash flow to live on, you better be very, very careful. Appreciation is icing when you get it. Depreciation, I like it today, but unless I'm 1031ing, I'm going to have to give it back one day. There's all the different things that people promote as a hedge against inflation, sure, but then you run out of good loans. So overall, I can tell you the disappointment I've had with my rentals is that there's not enough cash flow to get me into financial independence. I can brag about how many properties I have, but if I show you my P&L for 2020, it's disappointing. And that's why I think the note cycle begins now.
So, Chris, how many rentals did you have in 2020?
There were 17 properties with 30 doors. So
more duplexes than not.
Yeah, I have 3 fourplexes, a triplex, and a duplex, and the rest were singles.
So you have 30 doors that people rent, 30 front doors.
Before I started to sell them, yeah, that was 2020.
All right. And so you're a pretty savvy guy. I suspect you're not guilty of overpaying, or you didn't owe more than they're worth in today's market, right?
I owed $1.18 million and have a market value of $1.65 million. And that's my equity. And that is because I was buying them directly from distressed sellers and rehabbing them myself.
So that seems good. You own a business, right?
Correct. And
you managed them?
No, I have property managers in Alabama.
Okay, so you had them managed, but you're still managing the managers, right?
Correct, and that is not passive.
And you're not a rookie.
No.
I mean, you know way more than the typical guy that owns 4 or 5 rentals.
Probably, yeah.
So how much money did you make last year?
Well, on my profit and loss for the umbrella company that holds all of the LLCs with rentals in them, the accountant gave me a $35,000 gain on the profit and loss. So I gave it back and I said, I don't see it. Now tell me how much I cash flowed. Take out the ones I sold, take out the depreciation, take out the repairs on the new ones, and just tell me what the true cash flow would have been without, the new transactions. If I had the same houses at the start of the year that I had at the end of the year, income minus expenses. So on 30 tenants last year, I made a total net profit of minus $438 for the year, which is less than the tax return cost to file.
Now, by the way, disclaimer here, Chris said I would like to share this with the audience because I'm such a believer in this. So don't feel like I'm that kind of an interviewer will ask these, terribly imposing questions that are inappropriate. So Chris, thank you for sharing that, because I think a lot of people just don't really know what it looks like. We know what the headlines say, right? We know how things sound. And so you started on a path of realizing, man, Eddie, if I owner finance these houses, I could turn something that's breaking even into a heck of a good cash flow.
Well, I can tell you that when I thought about 2020, multiply 17 properties by the number 12 months in the year, and that's how many times my loans got paid on time. So if I'm sitting at a card table, I want to get out of my chair and get into the banker's chair, because that guy got paid, he made his money, his pro formas came true, the property manager got his money, all the contractors got paid, everything got equal except for me. And you know, I tell people, if you want to start buying rentals, you have to buy them very, very well, and don't do it unless you're committed to getting 10 of them as fast as you can. Because if you don't have 10 rentals, you're not going to make money, and they better be 10 great ones.
So, you know, I'm very connected with a lot of masterminds, a lot of the high volume wholesalers, turnkey providers. I've been in that circle a lot, right, for a long time. I was at a high-end mastermind back a couple of months ago, and probably the best list guy in the business, a guy that you happen to know, one of the best, I mean, considered to be the best list analyzer in the business. And he said what he had discovered is the guy that owned 6 rentals was not buying his 7th. The guy that owned 1 rental or no rentals was outpacing the seasoned landlord 20-1, meaning that the newbie is buying 20 properties before the old seasoned guy buys 1. And so I think the math that you're relating to us is probably the answer to the equation, because I thought it was really funny. You said ignore the pro forma, essentially meaning there are surprise invoices at every rental, right?
Yeah, and you can tell yourself you're putting reserves aside. You know, a good pro forma will say, oh, put aside repairs, put aside vacancy, and put aside capital expenses. And put aside 6 months reserve. I say model out 20 years and then find out, include those times of vacancy and the new listing fee, and put all those things in, because a listing fee is 1 month usually. You know, a turnover is not 5% of the rent. It's easily $4,000. And if you do that every 2 years, that is all your cash flow over the 2 years that tenant was there. Every 2 years, you get taken back to zero. So it's not the thing with a pro forma. It might be correct, but it's only for the first year. And so many people have bought with that first year projection. And by year 5, they're calling me saying, I want out. And those are the houses that we snap up and then turn around and resell right now.
Yeah, I say this a lot, but it's way cool to hear you say it, right? I mean, like people really think that they want to go do this. And so if you're listening today and you're thinking, well, man, you're kind of discouraging, Chris. No, what you're saying is it as the market has increased in price, you found what you think is a higher cash flowing, safer end of the market, which is the note side of the market.
Yeah, there will be a time when I start accumulating rentals again.
Yeah.
If I went back in time 10 years, I would, knowing what I know today, I would have accumulated a lot of rentals 10 years ago.
100%.
I just think there's a time to shift with the market. I mean, when I was in the stock market, I was buying index funds and leave them, and still I'm like watching paint dry, don't try to time it. So I kind of resist being a market timer in the stock market. But over here, I mean, it's not that much timing when you realize, look, rates are where they are, the economy's where it is, prices are going. Then you always show the number of loans available. The amount of money that's going into the lending pool is dropping. Yeah. So there's so much more opportunity. Let's say this. I don't think that owning rentals is bad if you go in knowing what's your 20-year projection. I think that notes is far better and far more passive, because even with property managers, you do not check out. You read those statements, you push back on those bills, you question why they're doing things. You have to push them to get the renewals done. Everything has to be driven, and it takes a lot of attention. I'm a project manager, I'm certified PMP, so I'm used to spinning a lot of plates at once. And I run my property managers hard. So I can tell you the idea, rental properties are not passive income. They're very engaged, and notes, I think, are much more. Maybe not entirely, not like buying 10-year treasuries, but they're much, much less, let's say they're much more passive than rentals. And definitely I see that as a higher return option. If I sold my rentals and took the equity that I described before, the 1.6 million and 1.1 million, and I just cashed that out, and I had that $500,000 after taxes and everything, and I took that and I bought notes at full retail value, I would do better than I would holding those houses as a rental. That would be a good move right now. However, if I can originate notes and I can buy them at a discount on your platform, now I'm coming out even further ahead.
You have a great perspective.